Welcome to Wealth from Walls, the monthly podcast show dedicated to empowering and safeguarding home buyers and investors in their pursuit of wealth creation through property. Join us as we provide expert tips and strategies in finance, law, and property to assist you in achieving extraordinary success in your property journey. My name is Amir Sehat, and I'm the Director of Project BT Property. I am an independent property advisor who utilizes data to analyze property market trends and streamline property acquisition. And today we will be talking about the latest updates on the property market, including interest rates. We'll also explore the pros and cons of investing in property through a self-managed super fund. But before that, let me introduce you to my peers, Mohit and Melissa, and also our guest, Toni Petrovski. Melissa Barlas is the Director of Convey and brings her expertise as an experienced property conveyancing lawyer. Mohit Pachauri is the co-founder of his mortgage broking business called Capital for Castles, and Toni Petrovski is the Director of ZT Partners with extensive experience in accounting services. Toni, thank you for joining us today. I am confident that your insight for property investors will be incredibly valuable to our audience.
No worries. Thanks for having me, guys.
Our pleasure. Okay, let's dive into the discussion. Mohit, what are the latest updates in the finance world?
So we had a shocking news on Tuesday, everyone, that the interest rates went up by, the cash rates went up by 25 basis points. So now it's sitting from 4.1 to 4.35%. This was first rate rise after 4 consecutive holds on the cash rate since beginning of July this year. Now, this was a 13th cash rate rise since May last year when RBI decided to increase the rate to curb inflation. Now, the implications it's going to have on house prices, borrowing capacity, and overall inflation itself, it can be quite a debatable topic, and different analysts have got different point of view as well. So I'm going to steer away from that, but I'm going to quickly go through 3 points that I think we need to be quite mindful in the current very, very volatile market. So for our listeners, first one is that if you have a pre-approval from a lender, then you should speak to your lender or your mortgage broker to make sure it still stands. Because as you know, when the interest rates rise, the borrowing capacity comes down. You don't want to find yourself in a situation where with the rise in interest rate, your borrowing capacity has reduced and you are still targeting the older hard price. So good to have a chat with them. Second one is, again, if you haven't had your home loan reviewed in last 6 months, this is the time now. It has been the time for last, almost 6 odd months as well. So speak to your lender, speak to your broker. If you don't have a broker, engage one, because, mortgage brokers, we write almost 70% of home loans in Australia, and we can bring you the options that your existing lender may not be able to offer you. We at Capital for Castles, we do a mandatory rate review every 6 months for our clients. And let me tell you, it makes a difference every time we come back with a positive news for the client. So make sure you speak to your client, to speak to your broker. And the last one is that if you are in the market to buy property, it's more important now than ever that you must get a pre-approval. The market situation, lender policy, interest rates, they are quite volatile. They're changing very, very rapidly. And all these factors, they impact your borrowing capacity. So you want to make sure that when you go bid in an auction for the property, you are safeguarding your interest as well. So those were my very quick 3 tips. Now, as Amir, you mentioned that we're going to talk about SMSF, which is quite an interesting topic at the moment. And this is something we're doing quite a lot as well. And obviously, this is a property investment under self-managed superannuation fund. And I'll come to you, Amir, and Toni, to get your take on it from property and accounting point of view as well. And Melissa, for yourself, from convincing and soliciting side of things, that what people need to be mindful of. But do you know the SMSF sector has grown in leaps and bounds in recent years? There is almost about 600,000 funds being self-managed, and it used to be 574,000 in 2020. So in last 3 years, it's grown up by almost 26,000. The total estimated assets of SMSF at the moment is about $890 billion, and property portfolio is about 7% for residential and 9% for commercial, which is a massive amount when you compare those figures. Now, a few years ago, you might know that major lenders, they started pulling out from SMSF lending. So now what we are seeing is that all the major banks, they're increasing their rates for the existing SMSF clients to essentially sort of push them away from themselves, because they are trying to get rid of them. But the smaller lenders, they are increasing their appetite, and they're welcoming these clients and the new entrants with open arms. So it's a good opportunity for you to speak to your mortgage broker. And again, if you don't have one, engage one, to go through a review of what's the best you can get from your existing SMSF loan that you might have with one of the major banks, because we're seeing almost 2 to 3% difference in the interest rates between major, what they are charging compared to what new smaller lenders are offering now. And again, the closing note, let me just go through this one more time. The cost of doing nothing in current market can be really, really high. So don't sit idle, speak to your lender, speak to your mortgage broker, take action. There will always be some nuggets that you will find from these conversations. That was it from me. Now, I mean, you deal with a lot of investors. So from an SMSF point of view, what are you seeing? Are you seeing interest increasing in the property market for the buyers?
Look, the short answer is yes, Mohit. There has been an observable increase in interest in property investment through self-managed super fund or SMSFs, especially after the volatility that COVID-19 brought to the stock market. Investors are often attracted to property as an asset class because it is considered to be a tangible investment and is perceived to have a high level of stability during times of stock market uncertainty. During the pandemic, the stock market experienced significant fluctuations, leading many investors to reconsider their portfolio and look for more stable investment opportunities. Real estate is often viewed as a hedge against inflation and can provide a steady income stream through rental returns, which is appealing for those looking to diversify their retirement saving. But it is important to note that while property can provide certain benefits in a SMSF, such as potential capital growth and rental income, there are also risks and complexities associated with it. For instance, property is an illiquid asset and can take time to sell if funds are needed quickly, especially if the property is poorly selected or situated in an undesired location. However, this problem can be significantly mitigated with the right purchase and through solid due diligence. For instance, it might take 90 to 120 days to sell a property in certain location, whereas it only takes 7 to 14 days in a well-chosen location. So basically, it is all about buying the right property in the right location. It is also worth mentioning that managing SMSF effectively requires level of financial literacy, especially when it comes to property investment. These investments should be carefully evaluated to ensure they align with the fund's investment strategy and adhere to compliance regulation, which is very important. And therefore, when purchasing property through a SMSF, it is prudent to engage with experts. This expertise can maximize rental income and capital growth, which in turn contribute to building substantial wealth, and this wealth can pave the way for a comfortable retirement. Given that the ultimate goal is building sufficient super for a comfortable retirement, it is essential to choose properties wisely, ensuring they fit a sustainable and effective investment strategy and cash flow model, while also protecting retirement saving from unnecessary risk. It is very, very important. This is very important because while anyone can buy property, not every investment leads to a successful outcome. And that is why careful planning and strategic investment are essential to avoid jeopardizing financial security in retirement. In summary, the interest in property investment within SMSFs after the pandemic indicates that investors are seeking stability and alternative ways to safely build their retirement saving. But remember, this is not a one-size-fits-all solution, and each investor needs to seek professional advice to ensure it is the right move for their unique financial situation. I think that's enough from me. It would be beneficial to also discuss the legal aspects of SMSF and property investing, and Melissa can definitely provide valuable information in that regard. So, Melissa, in your opinion, what consideration do people need to take into account from a legal perspective when buying property in a self-managed super fund?
Yep, really important. There's a few aspects that I want to talk about. Well, I won't take too long, but I think there was a really good point of that Mohit mentioned earlier about getting your pre-approval as early as possible when you're buying with a self-managed super fund. It takes lenders a lot longer to process finance compared to if you're buying, as an individual. And Mohit, can mention something about that, but certainly getting those pre-approvals is really important. So I wanted to emphasize that if you are in the market buying for a self-managed super fund, and it's a long-term strategy for you because you're buying for retirement, right? So when it comes to buying under a self-managed super fund, in terms of some of the basic rules involved with that is you have to rent. If you're going to rent it out, it needs to be rented out to the market, can't be rented out to a relative or to a fund member when you are buying a property under a self-managed super fund. The only exception to that is if it's, let's say, a commercial property, you're going to have a business running from it. You can lease it out to a fund member for their business, so long as it's a lease at the market rental rate. But there are certain rules or specific rules associated with doing that. So, of course, buying under a self-managed super fund, I can't stress enough, just like Amir said, speak to your accountant before you buy, speak to, a commercial lawyer if you're looking to rent it out, to your business, if that's something that you're wanting to do, and even a financial advisor, which we can, of course, introduce you to, but very important steps to take in advance. Other things noteworthy from a legal perspective with self-managed super funds, when you are buying under one, you need to meet what's called a sole purpose test. So just making sure that with the purchase activities, they're all in relation to, or they're all being done for the purpose of providing retirement benefits to your fund members. So, for example, you want to make sure the deposit is paid from the super fund and not from anywhere else, because the tax concessions that would otherwise be available for a self-managed super fund may not be there if you don't meet that sole purpose test. And your accountant can go into a bit more detail around that with you, but just making sure that at least the activities in relation to buying the property are for the purpose of retirement benefits, making sure that's all coming from the super fund is really important for that reason. One thing that I find, and this can sometimes happen when there's an oversight by the conveyancer, is the requirement to notify the State Revenue Office after settlement that you've actually acquired a property under a self-managed super fund. And that principle applies if you're buying under any trust, discretionary, unit, fixed, super fund. Doesn't matter. You need to notify the State Revenue Office after settlement that you've acquired the property under the super fund. We definitely, when we're representing clients, ensure that always happens. We've always got our checks and balances in place, but you've got to just keep that at the back of your mind, have a discussion about that with your conveyancer, because it's something that I've seen over time conveyancers have missed, even lawyers have missed, and then clients are getting assessment notices based on them as an individual rather than, land tax assessment notices from the State Revenue Office that doesn't record the property as having been acquired for the super fund. So just making sure that the State Revenue Office, who charges land tax, is notified after settlement that you've acquired the property under the super fund is a really important step once you settle. So just something to be aware of. And just as a heads up, if you are buying under a self-managed super fund, you won't get the same concessions that you might otherwise get on stamp duty if you were buying as an individual. So it's just something to be aware of. So you've got to factor that into, I guess, your strategy with, the entity that you're going to use to buy a property, whether you buy it under the super fund or otherwise. Like, for example, if it's, going to be, obviously, if you're buying a property as a home in an individual name, you might get the principal place of residence concession on stamp duty, depending on the purchase price threshold, but that's not going to be available when you're buying under a super fund, for example. So just little things like that. But they're sort of the main considerations that I think are noteworthy when it comes to buying under a super fund from a legal perspective. But what I'd like to hear is a little bit more from Toni. And I think the first question I should ask is, Toni, tell me a little bit more about you and your business in the context of self-managed super funds.
Yeah, sure thing. Thanks, Mel. So a little bit about myself. I've been an accountant now for 15 years. I started my career with an accounting firm in the city who I was with for around 7 years. And back in 2014, my business partner and I started ZT Partners. We offer specialized taxation and business services to mainly business clients operating in a wide range of industries. Our clients range anywhere from your typical mum and dad business to our largest client, who turns over close to $100 million. And a little bit of a fun fact about ZT Partners, we're going to be celebrating our 10th birthday this February, so that's pretty exciting. Regarding SMSF and property investments, I have seen a lot more demand from my clients and new clients that I've picked up as well over the last maybe 12 to 24 months when it comes to investing in property through SMSF. So just in the last couple of months, I've done 2 or 3 of them. So there's definitely a lot more demand for them, as Mohit mentioned previously. So yeah, definitely an area that's picking up.
Right. And maybe just bring it back down to a real basic level. Just tell us, for those that don't know, because we can't assume everyone knows everything about self-managed super funds. What is it? Maybe we can identify what is it? What is a self-managed super fund? And what's the positives of investing in property under a self-managed super fund?
Yeah, sure. So self-managed super fund is just a type of superannuation fund that individuals can manage themselves for their retirement savings. One of the main advantages of an SMSF is you have greater control over your investment decisions, which means you can invest directly in property. Owning residential or commercial property within your SMSF, which is rented to tenants, can add some serious value to your SMSF via rental income and capital growth over and above what you might be able to achieve if you simply left your super in an industry super fund. Also, using funds within your SMSF to purchase a property is a great way of freeing up capital that might otherwise have been locked away until your retirement. So that's another benefit of SMSF investing. And I think a really good benefit is the low tax rate associated with SMSFs. The current tax on earnings for an SMSF is 15%, compared to 25% for a company and up to 45% for individuals. This tax rate differential offers a great opportunity for tax minimization. And let's face it, we all love to save tax.
I think that's a very key consideration for a lot of us that want to buy under a self-managed super fund. So that's great.
Definitely.
So I was also going to ask you as well, what are some of the things that people need to be mindful of when it comes to investing in property under SMSF?
Yeah, sure. Mohit and Amir, and even yourself, you touched on some great points there. There are some very strict rules that govern what you can and can't do when it comes to property investment under an SMSF. together with added administrative and compliance requirements. First and foremost, like Amir mentioned, I think the most important thing is finding that right property for the SMSF. Given that you're making a decision that could affect your retirement, finding the right property is integral, and speaking to someone like Amir who'll be able to guide you in the right direction is very important. Once you've decided on a property, the next step is to speak to your accountant and your mortgage broker. As an accountant, I can assist with setting up an SMSF and rolling over any money, any super money that you have in your industry super funds into your SMSF. I can also assist with setting up a bare trust, which is necessary if the SMSF will be borrowing money for the purchase of the property, and also any ongoing ATO requirements. Now, if you'll be needing a loan to purchase a property within your SMSF, you need to make sure the loan type is a limited recourse borrowing. Mohit has experience dealing with these types of loans. He can assist with this step, and he'll also assist you to get the lowest rate possible. I think finally, for a smooth settlement process, as you mentioned, speak to yourself, and you'll be able to make sure that the SMSF and the bare trust is correctly listed on the contract of sale and with the SRO. Any mistakes here can be really costly and can result in double stamp duty if not done correctly. Just in a nutshell, really, given the complexity of this area with SMSFs and property investment, I think it's really important to surround yourself with a team of professionals who have experience dealing with SMSF property investment and a team that have actually done it before. Don't go to someone who's never done this, because one wrong move can result in some really hefty penalties, and it could really affect your retirement savings in the long run.
Yeah, I love the point that you made about the bare trust. That's really important. If you're getting finance, it's very important. Speak to someone like Toni to help you set up the bare trust. So it's not the super fund trustee entity that goes on title, it's the bare trustee for the bare trust.
Spot on.
So that you don't run into those stamp duty issues and all sorts of things. So really important point. Thank you, Toni. And I will hand it over back to you, Amir, for closing.
I really appreciate you, Toni, for sharing all these valuable information, and from Mohit and Mel. This session, I think, covered a lot of information regarding SMSF. That wraps up our show today. Thank you, our audience, for tuning in. We hope you have gained some valuable insight from this episode. If you have questions or thought to share, please don't hesitate to reach out. You can contact us, leave a comment below, or connect with us on our social media platforms. Remember to subscribe and leave us a comment if you liked what you heard today. Your support helps us grow and improve. Join us for the next episode for more engaging discussions. Until then, take care and keep in touch. Bye.